This is Advisor 3.0, a show designed to help you as a financial advisor elevate your professional practice, transform your clients' lives, and take your business to the next level. I am Abraham Okusanya. Welcome to the show. If you like me, you're constantly struggling with keeping up with the regulatory regime, everything from consumer duty to senior managers regime to whatever the regulators come up with. Fear not, my guest today is a pro and he will help us walk through the maze of regulation. David Morrey is a partner at the financial services regulatory practice at Grant Thornton, where he helps firms deal with the challenges of current regulation and emerging requirement. David, welcome to the show.
Hi, Abraham. Great to be here. Thanks for having me.
And of course, David, you have your own podcast, Risk and Regulation Unraveled. I have been listening to that every time I struggle to sleep. I put your podcast.
Well, that podcast has been running since lockdown, so it's been going a few years now. I'm here today to learn from the master. So up my game.
I wouldn't put it that way. No, thank you very much for making the shows, giving us the time. For those who maybe have been living under the rock, tell us a little bit about your career journey and what first drew you to financial services and regulation.
Well, I stumbled into financial services at university. So I trained as a chartered accountant. Mainly because the astronaut program wouldn't take me. And I went to work for an investment manager after I qualified, and I was actually a risk guy. And I guess my journey to being a regulatory person is defined by the fact that as the years went by and I was trying to help this organisation identify and manage its risks, basically all of the risks and all the priority risks ended up being those ones which the regulator was setting. So at some point it just became inevitable that you couldn't have a conversation about risk without being up to your eyeballs in the regulatory requirements. And that was essentially 10 years ago. So the last 20 I've spent specifically on compliance issues, compliance change. I think I'm a bit too old to change at this point. I'm probably stuck in my ways, I think. And
you've been at Grant Thornton now?
Just over 10 years. 10 years. Yes, I'm head of the regulatory advisory practice. And as you said in the very well scripted website introduction, we help firms with regulatory challenges. Do a lot of skilled person reviews. That's a sort of party piece that kind of ebbs and flows a bit depending on regulatory demand. But I've done about 50 of those, which is I think maybe a record at the moment. I guess I've got to see over quite a long period of time now, best part of 30 years, how the regulator has evolved.
Incredible. So how would you describe the regulatory landscape today?
In many ways, it's harder to read today than it has been for quite some time. And that is because the regulator is trying very hard to embrace the growth agenda.
We
can come on to that. But they are very much taking that seriously. So I think there are the whole range of issues, problems in the industry, in the sector, the regulatory problems that 2, 3, 4, 5 years ago, you'd have been pretty confident in how the regulator would respond, what they would require, what the answer would be. And that's not so much the case today. And I think, probably one of the big examples of that would be ongoing advice.
Yes.
And the regulator rightly raised some concerns about whether advice firms had been providing an annual suitability review in return for an annual fee, something that would have been in the contracts, terms of business those firms had. Since 2018 and MiFID II, it's been in COBS with a requirement to produce an annual suitability recommendation in return for your annual fee. As we all know, some firms more so than others, but there were issues. Not everyone had delivered those reviews. And I think scroll back 2, 3, 4, 5 years, it would have been pretty simple to predict what the regulator would do, which is probably some kind of market-wide past business review, mandated review to remedy what can only be described as consumer harm. If that's not the definition of consumer harm, paying for something you don't get, I don't know what is. And what's happening in practice, because this has sort of straddled the Chancellor leaning on them to be more growth focused. They've dialed that back a bit. They still want some remediation done. They still want firms to look internally at how they've been meeting their expectations, but they haven't really mandated anything. Actually, they've been quite relaxed about firms taking different approaches to this. It's been a real live case study for me to see how they've been trying to flex their supervisory approach to adapt to the growth agenda, or in this case, not take a position that would probably have killed off quite a lot of financial advisors because they wouldn't have been able to afford the redress liabilities.
So you think that is essentially their response? They pivoted, let's put it that way, away from going down hard on firms, just primarily because they want to be seen to support the growth agenda, rather than they looked at it a bit more and they said 8 out of 10 clients did get the advice that they paid for, and so we shouldn't bother about it.
Yeah,
the other 20.
They didn't know. In order to get to that 8 out of 10, they basically had to decide that clients who didn't get an annual review, but where the advice firm had made was a reasonable and proportionate efforts, I believe, is the thematic feedback. So there'd been some effort to try and provide them with an annual review, and it didn't happen for whatever reason. But that was a pass. And that's fine. I have a lot of sympathy for that. That's the way the industry works. You can't compel clients to take an annual review if they're unresponsive. But that's not what the rules say, and that's not what the terms of business say. Again, yes, I think there was a bending of the rules, or an interpretation applied to rules that benefited the industry, frankly. And I don't know if it's growth per se. I think the confluence for financial advisors in particular is there is a desire for the FCA not to be seen to be stifling growth, but there's also a very strong desire to bridge the advice gap that they talked about at length. I think with ongoing advice, they were looking at a situation where if they came down hard on the industry, the advice gap was only going to get a lot bigger because people would potentially be driven out of the industry. So they made the right decision in my view to take a sort of firm by firm approach and not be too directive about what was required. And with the result that there isn't a big dislocation in the advice market as a result. You see it with targeted support as well. I mean, that's the big regulatory development clearly for the advice industry. Lots to say about that. I mean, obviously, it's not just for the advice industry. It's arguably, as has been described by those more eloquent than me, a love letter to the banks, basically. Gives the banks, with all that wonderful data on clients, the opportunity to say, dear clients, banking client, people that look like you often invest in one of these little investment funds that we might have sitting over here. Why don't you take a look at that? And I guess there's various. I mean, the compulsion there is, or the desire there is to make it easier for bank deposits, what are currently sitting in unproductive bank deposits, to make their way into investments. And obviously, that's a strong political push, which the regulator's responding to. Regulation being moulded a little bit, interpretations being moulded a little bit to make that agenda work. And one of the things that stood out to me in the targeted support consultation paper was pretty much an expectation, but a very, very clear statement that if you wanted to cross-subsidise, take the fees you earn from client X in order to pay for the targeted support service you're offering to client Y, that's fine, actually. And it would be really good if you provided targeted support free of charge. So cross-subsidisation, which is an incredibly challenging thing to deal with in pretty much all regulated financial services activity. For targeted support, they're saying it's probably a good thing. It's a healthy thing. So for me, that's another example of really focused around, the politics of wanting to get all these bank deposits shifted into productive investment assets.
I'll come back to. I want to come back to targeted support. But before I do, one thing that that I've heard often from financial advisors about this ongoing advice thing is that if there are a range of things that we do for clients that don't necessarily require, let's say, a face-to-face meeting.
Yeah.
So. Yeah. For instance, we might let's call them desk work. We might have revisited the financial plan. We might have updated the financial plan. We might have looked at things like annual allowance. For the client, annual ISA allowance. Annual. We've looked at the LTA, lifetime allowance, those sort of things, and we've done that work. But we haven't necessarily, let's say, met the client one-to-one. Would you say in that scenario, as long as it's documented and there is evidence for what we've done, we are meeting the regulatory requirement? Or is it a case that every year you have to meet the client, you have to, provide written recommendation to the client? How would you?
So there's a backward-looking angle to that. So back in 2019, back in 2020, what did we need to do in order to meet, in order to not pay redress, in order to say we've done just about enough? And I think that there's definitely an argument there, and I think in a lot of cases, firms can show that they provided a service of value made up of other constituent parts. They might not have produced here's a nice printed document with here are your recommendations. They might not be a face-to-face meeting, but but there was a service and it was arguably sufficient enough to justify the fee that was taken. Firms, because they've been allowed to review their historic ongoing advice sales without too much regulatory supervision, firms are making those kind of judgment calls about it might not have been an annual review, but it was close enough. I think moving forward, whether I was right or wrong in the past, moving forward, you've got no excuse. So you are welcome to the consumer duty. You've got a fair value assessment to make. The fee that you are charging needs to be justified by the service you're actually providing. And I would suggest at quite low fee levels, everything you're answering a couple of phone calls, helping someone with their login details if they forget the platform login, or those kind of things. That have even just having an advisor available, even if there is no contact, probably has some inherent value. You hear the FCA talking about that. So there's definitely a fee level that can be argued that supports quite a lowish level of service. But as soon as you start ramping up those fees, how do you make your fair value assessment work? It's got to be, for an advice firm, it's got to be something around personal service and interactions and support. At any kind of meaningful level of fee income, I think it's beholden on firms to offer to have the kind of higher quality interactions that you're describing. I mean, the rules still say, COBS rules still say, take an annual fee, produce an annual report and an annual suitability recommendation. The FCA is clearly talking and thinking about, it's you can construct different terms of business, terms of service, which might allow you to charge, for certain groups of activities, groups of services short of an annual review on an ongoing basis. Right. And I would expect probably COBS will be modified in due course to allow that flexibility. But at the moment, at least, if you're taking a meaningful fee, then you need to provide a meaningful level of service.
And so let's come to targeted support. As you said, I read an article in CityWire that basically said financial advisors, by that I mean, smaller independent firms aren't really interested in targeted support. And it is, as you said, a love note to, banks, maybe large, direct-to-consumer platforms who want to, flog their wares.
Yeah, I think that's okay. So, yes, you will want to do this if you've got a lot of customer data, but also you've got an investment product to sell them. So those small advisors, they won't have their own fund. The funds in most cases, obviously. So when I first read the initial discussion paper, my feel was that most advisors, like the overwhelming majority of advice firms, are not going to be interested in ongoing targeted support.
Right.
My mind has changed a bit since.
Okay.
Well, for a couple of reasons. The big one is if your client is it's your client, advice client, and they have to bank with Lloyds Bank. Lloyds Bank will be sending them targeted support. Lloyds Bank will be saying, "Why don't you invest in blankety blank fund?" That probably Schroders in that case, but so all of the banks will be doing it. So to your clients, so you may want to consider doing this some form of targeted support just to give them something else to listen to, particularly if they're not engaging. Clients are not engaging around ongoing advice in the way you'd want them to. So as a defensive measure, I think it'll be a thing. Having said that, the real kicker in the consultation paper for me is that in order to have it's an additional regulated activity, so people have to apply for and be given approval for it. It comes with a £500,000 regulatory capital requirement.
Wow.
Which is another way of saying if you're small, forget it. But for me, that's obviously it's a consultation process. The regulator will be getting feedback. For me, that's one thing that I'm quite uncomfortable with that £500,000 cap requirement, particularly because it effectively excludes the large majority of advice firms from something that's at the very least is an evolution or tangential to their core business. So yeah, we'll see whether that £500,000 remains when the final rules are announced.
Okay, so consumer duty is now been in place, for
yes.
I think
2 and a bit years. Yes.
2 and a bit years.
Yeah.
What's your assessment of where firms are today and what you're seeing from the regulator? Is the regulator comfortable that firms have broadly got a handle of this?
So consumer duty is one of those few regulatory developments that basically applies to all regulated firms.
Everybody, yeah.
Pretty much, yeah, like 70,000, I believe, is the number that are regulated these days by the FCA. So advice firms have always had the easiest challenge under the consumer duty. DFM's advice firms. Sorry, anyone that's sitting at home disagrees with me, but yeah, I mean, yeah, if the objective of the consumer duty is broadly to ensure that the individual consumer with their own personal needs and circumstances and vulnerabilities and all the rest of it, to ensure that individual gets the right outcome and the right service, then a personal advice firm or personal DFM should be able to do that.
Yeah.
Much more so than Barclays Bank because of the number of touch points, etc. There are still areas that they need to improve on. Maybe come back to that. I mean, I distinguish it from, say, investment platforms.
Yes, all right.
I don't know whether you know any of those. Well, no. So investment platforms obviously built around technology, built around as much as possible standard processes. There's obviously a cost and efficiency angle there. So actually, providing the same treatment for all customers is pretty easy for an investment platform, but providing something that might look and feel a bit different for different categories of customer is potentially quite hard from a systems point of view. So advice firms have it a lot easier than most. Having said that, outcomes testing and fair value assessments, the FCA provided some feedback. They'll provide more by all accounts in the coming year. One of the things I found most interesting, and it was skilled person work we were doing last year, as it happens. And so I've done a lot of skilled person work on advice firms looking at suitability. So very, very common ask is let's look at client files. Have they received a suitable outcome? Has the firm itself assessed the outcome correctly from a suitability point of view in their own QA processes? And then post-consumer duty, we're still being asked to do that, but we're also being asked to, and besides a suitable recommendation, did that customer receive a good outcome? Customer support, consumer understanding, fair value assessment factored in there. And so one of the really interesting experiences for me, and I guess it's kind of something of an extreme example, but we looked at 100 cases for one particular advice firm, And I think 99% were passes for suitability.
Mm-hmm.
And I think 99% were fails in terms of the broader consumer outcomes, mainly around consumer understanding and evidencing that. Now, that's probably less painful for the firm than a suitability fail, because that's probably going to lead to expensive redress potentially. But it just illustrated to me that, there's this expectation that firms will test outcomes, which is completely part of the consumer duty. That is not, for most advice firms, that is not the same thing they've been doing historically. They've been looking for suitability recommendations, and now they have to think much more broadly in terms of what's a good customer outcome.
Yeah. And so in this sort of consumer duty assessment, I want to pick out, our own particular segment of the market. So you mentioned platform there.
Yeah.
It can be hard to provide slightly different service and communication to, different clients. It gets worse if you are like we are, our part of our business, an MPS, managing money on third-party platforms under agent as clients, which means we have, with that 98% of clients, we have no direct contact with those clients. The advisor is the client under this construct. We can provide, support and materials and documentation. We can test on our own and then offer it to the advisor. But they're under no obligation to use it or pass it on. We provide all sorts of tools for the advisors, fact find, financial planning tools. They're under no obligation to use it. And then when it comes to vulnerabilities,
yes.
A, we don't know the client. We have no relationship with the end client. And B, even if you go and ask the advisor about, the level of vulnerability in their client, that sort of thing, they're under no obligation to provide it. So how on earth do you meet this kind of obligation?
I could attempt to give my view on how you would do that, albeit it's really hard. But the good news, though, is that the FCA are going to review this. Mansion House speech, Rachel Reeves, she's directed the FCA to review how the consumer duty applies to wholesale firms, i.e. firms that do not have a direct interaction with the end consumer. I haven't got any details on that. I mean, a letter has been written saying we'll look at it. But yes, I agree. And there's the only possible way where a manufacturer who does not have any interaction with the end client can fully demonstrate they're meeting all the requirements is if there's a huge amount of data sharing with the distributors. And that doesn't happen in a lot of cases. It probably won't. I mean, a little bit of it happens, but
in any case, like the essence of agent's client, and the way many advisors see it is I own the client relationship and I will engage with you as though I am the client. I don't want you to have my client data or that level of client data. Sorry to interrupt.
The FCA know that this is not working well. It's not just in this sector. The same thing works in insurance intermediation, the general insurance brokers and the like. You've got exactly the same dynamics there. Hence is now going to be reviewed. So I would expect that will be dialed back a bit. One of the truisms I've come to learn over the many years of interpreting regulatory changes, from the sort of sound bites at the start to the detail of the whatever guidance or rules are produced. There's a lot of things that kind of creep in there that maybe make it a little bit harder than you people expected it to. So I think there will be. It's a really interesting. So I guess one thing I would say for a wholesale investment platform at this point is, why would you spend a lot of time and money trying to improve your existing consumer duty compliance arrangements? Now there's a review going on that might reduce them, and so for most in your situation, it would probably be let's have a bit of a wait and see what pops out. We might be able to get rid of some of this stuff.
Interesting. Okay, so you mentioned you probably have the record in the country for completing the most skilled person review. That's Section 166. I don't want to guess. I can't speculate on which ones you've done. But what is the status now? The status quo now. Last year, it felt like the FCA was handing this out to firms like candies. Is that still the case?
The government pressure to be more growth orientated. One of the first things the regulator did was the FCA, I should say, because the Bank of England also do these things, which won't affect this industry. The Bank of England have not slowed down their skilled person reviews, but the FCA dialed it back radically. It's essentially like 25% of the prior year. Now the prior year was not quite a record, but close to a record. And there were a lot towards the top end of the spectrum that you see of these things, and they've dialed them back. It's interesting. I would have said for a lot of organisations of a certain size, it's pretty much inevitable at some point you'll get a skilled person review, even if it's just because the regulator wants to kick the tires a bit, just to get to know you better. So it's not necessarily the end of the world, a really, really bad thing. I have to say that if you get a skilled person review now, i.e., late 2025, it probably is a bad thing, because the only skilled person reviews they're kicking out, more or less, are where they know there's a major problem. There's a genuine customer harm is happening, for instance, and so they've kind of they've narrowed down. You have to work harder to get a skilled person review, and something quite serious probably has to be going wrong. Now, that's today, and it was, as you rightly say, 12 months ago, there were a lot more diagnostic style reviews where the regulator just wanted to know, consolidators buying lots of things. Are you doing it properly? So it was an open question, not necessarily a problem. And so they'd use a skilled person power to get some comfort there. Today, much more likely to be there was a genuine consumer harm scenario that has gone wrong, and the skilled person is needed to find out just how bad things are. We'll see. Next year might be different.
So are you saying, given how prevalent these things are, especially for larger firms, as firms are growing rapidly, would you say that we should expect more of them and not see it as the end of the world, or less?
Well, I say today, because they're trying to manage the number down. I think you'd only get one if there was a very obvious issue. But generally, if you look at this over a decade-long lens, then absolutely, if you are a fast-growing firm, or if you're a established firm that's starting to do something new and different, or if you're just in a sector where they know there've been some problems elsewhere, those are all factors that can contribute. And one of the interesting things, so they said the regulator has responded to the growth agenda by saying, well, we're going to produce fewer new rules. So a few things went straight in the bin. The sustainable, it's the SDR, sustainable regime for portfolio managers, in the bin. Polluter pays reg cap rules for the advisor sector in the bin. Targeted sport, it's kind of obviously clearly not gone anywhere. That's big and significant and nasty and things. So they dial back. But what they have not dialed back is thematic activity. They haven't dialed back guidance. So organisations are probably more likely than ever to have a visit from the regulator for a chat. Yeah. We've had the massive 165, the data request across the wealth industry. There'll be visits off the back of that. So thematic visits haven't gone away. They've gone up. Skilled person work might have gone down, but your chances of actually getting a visit from the FCA is now higher, I would think. I would suggest. Any interaction with the regulator needs to be handled with care so they don't get the wrong idea.
And I promise you, I'll leave skilled person review after this question, which is, I also understand that some firms can do a skilled person on their own rather than being imposed by the FCA. Is that common?
Well, okay. So
I'm sure you recommend it.
So there's something I refer to, gets called in the industry a shadow 166 or shadow skilled person review, which is a review that's done not under a skilled person panel, but looks and feels very similar to a skilled person. So if you are in a dialogue with a regulator, which you think it might be leading you towards a skilled person review, then one thing a lot of organisations do is they commission their own. They get Shadow 166 done, and if we've already had this review done, so the regulator, you don't need to commission the same review. That works sometimes. Right. Sometimes the regulator says that's very nice for you. We still want our skilled person because they're our skilled person. It doesn't necessarily getting a shadow review done won't necessarily mean you don't get a skilled person review. At the very least, though, it should prepare you better for a skilled person review because you should know what the issues are, and you should have some opportunities therefore to try and fix things. But there were a lot of these shadow reviews when the regulator finds out you're doing them, says, "Oh well, we would like to talk to the firm that's doing it for you. We would like to see the reports, drafts." So it ends up feeling a lot like a skilled person review, even if it's not done under that Section 166 power. But yeah, there's a there are various things. If maybe less so than previously, but I've definitely seen over the years some of the skilled person work I've done. The organisation, the firm we are reviewing, has had to work quite hard. By which I mean they've said the wrong things to the regulator. They've communicated badly. They've just handled the whole regulatory interaction quite badly, and the regulators, unsurprisingly, probably come to the conclusion, some version of that. I don't know why. I don't trust them, or they don't know what they're doing. Hence a skilled person review. So, a lot of skilled person reviews over the years were probably avoidable if a firm had just handled the regulatory interactions better than they did.
Okay, so let's go to thematic reviews. What areas do you think they are interested, or have they said they're interested in right now?
Yeah, well, so I mentioned fair value assessments and outcomes monitoring for advice firms are going to be a focus. Things we've already had. I mean, one of the jobs of a compliance officer traditionally has been getting the draft rules that the regulator's producing a new piece of regulation. Here are the draft rules, and the heads of compliance takes that and goes off and does a gap analysis and works out what the impact's going to be. And that's still, something like targeted support, that still happens a little bit. But more so now, because the amount of new rules is reduced, you're seeing thematic reviews and guidance, et cetera. And the heads of compliance now need to be spending time looking at those publications, which might just pop up as a web page, for instance. And they will have, the regulator will set out, classically, this is the good practice we observe, this is the poor practice we observe. So the heads of compliance need to work their way through those in the way they would have done historically with the new rule sets. I think one of the dynamics that's been interesting for me to see literally over the last 5 or 6 months is heads of compliance mostly know this. They know, as I said, they're probably more likely to get a visit now from the regulator than they ever have before. The volume of these thematic feedback documents is high. Throughout 2024, there were, I think, 7, 8, 9, I think, just on consumer duty, and the more to come. But equally, some of their executives or board members have got this idea. Well, they've read the Mansion House speech or something, and they know light touch regulation, growth orientated regulation. And I am a bit concerned that in a few organisations, compliance officers saying, "Well, I've read the guidance and we need to do X." That's a harder sell to some executive teams than it has been, because the executive team has decided this is not now the time to be spending money on compliance because it's light touch regulation, which it definitely is not. They've
clearly said that they're going to look at MPS markets.
Yeah.
What are your thoughts? What do you think they're going to find? What do you think they're concerned about?
We should very soon, in fact, get the feedback on the MPS thematic review. MPS is a tricky one because MPS there's quite a wide variety of different structures in use, and everything from what amounts to just essentially research, i.e., you've through to proper fund structures and all points in between. So I actually think one of the reasons they've done this MPS review is to get a better idea of how the market works and what the different structures are and where the different responsibilities are. I think this is a diagnostic. I don't think they necessarily will land on here are a lot of direct recommendations or changes we need to make. I think it's more likely they'll say, okay, these are the areas we want to do some more exploratory work in.
Interesting. Looking at the horizon, is there anything that concerns you in the wider, investment market platform, that sort of area that you think the regulator might get around to looking at, or where risks are emerging for consumers or the industry?
One quite narrow point, but I think it won't go away, is that the FCA have been thinking about advice firms and the regulatory capital requirements for advice firms for quite a while now. And every time they report sort of financial services compensation scheme numbers, it kind of leads back to, well, a few advisors have contributed disproportionately to this number, and they've disappeared because they've gone bust. And so they have floated a few thoughts on how they might change the regulatory capital requirements for advice firms. They have obviously been doing, and again, we're waiting for the feedback on this, a thematic review of consolidators, and that interestingly has focused, arguably more so on the regulatory capital, the financing, how those are financed, and where the loans are sitting, and whether the organisation is being put under a lot of stress in order to meet debt repayments, etc., interest repayments, to the detriment of consumers, etc. So I think it's a tricky one in the sense that they can't change it that much, because a lot of advisors will probably end up exiting the industry. If capital requirements jumped up a lot, but I do think it's likely to some changes is likely to be made in due course. So watch this space for that. I think more generally, in terms of these big ticket things, I find the direction of travel, which is because we have this overarching consumer duty, which makes some very broad statements around value and good outcomes and the consumer support, that maybe we as a regulator can start getting rid of some of our more detailed rules, COBS, PROD.
Interesting.
Why do we need a UCITS KID?
Yeah,
there's that in the regs is defined to the nth degree. What can't we just allow firms to use their own judgment as about what consumer needs are, which is what, to some degree, I mean, it's a mixed bag. The consultation, the CIC consultation is considering. If that plays out in practice and they do genuinely pull some of these detailed requirements, then firms will have that fascinating, thrilling, scary opportunity to say, well, I haven't got a detailed rule to follow in this, so I'll just do what I think right. Yeah. But that takes, of course, what that means is the regulator's no longer prescribing something very specifically. You have to work out, use your own judgment about what's in the customer's best interest. And that is that's the ultimate end game, I guess, of the consumer duty and of principles-based regulation more generally. It's a massive manifestation of Brexit, frankly, in terms of so many of these EU rules potentially, or regs potentially going away. I know I have my own doubts as to how quickly that will happen, and I also have my doubts as to whether the devil will be in the detail, and it won't be quite as clear cut as that. But I think in terms of sort of macro trend and something that would impact every financial services firm, if that does happen, that you have to decide for yourself what compliance looks like, as opposed to just following a.
Would you put money on it happening in the next 5 years?
Not in any material. It's a tricky one.
It's a big shift.
It is. It is. It's the and it's the balancing, impact on the industry with consumer outcomes, the growth versus consumer outcomes. It's hard to imagine something like that surviving a big mis-selling scandal, for instance. If I look at this current kind of growth focused agenda, what would derail that? Well, finding out that blankety blank bank or whoever had missold bazillions of a particular product. that we put all of our low risk customers into private assets, illiquid private assets, because that's productive asset. And then there's some kind of a crunch, which means that goes badly wrong. So yeah, I guess if it's a 5-year time frame, my view would be that something's bound to go wrong, and that will change priorities.
Interesting. So then, you mentioned earlier, just briefly, about debts sitting on financial advisory firms. By that, I mean consolidators largely.
Yes. Well, usually not sitting in the financial advisory firm, sitting up the structure somewhere.
Of the structure. And, this is according to CityWire. There's like £3.5 billion of debt on these large consolidators, of which 2.5, 2/3 of this debt is in some sort of offshore structure, Cayman Islands, where the
Jersey Bidco.
Bidco, where the FCA has, little, shall I say, oversight on what's going on.
Yeah.
What's your sense of what they should be doing, or what they will do in that space?
It's interesting. Well, I think again we'll kind of repeat where I started, which is to say, 2, 3, 4, 5 years ago, I think it'd be pretty clear where the regulator would go. And now, because of the growth agenda, it may take little baby steps towards it. Rather, but I think what they would like to do is, and arguably the current rules, debatably could be used is to pull those Jersey Bidcos or those Cayman companies into the UK group, if not for reg cap calculations, for advice firms at least, but at the very least so that you can do a sort of threshold conditions, financial resources view. So I think they would probably like to change the rules to make it explicit that they were included, but they've probably got enough levers right now to pull them in if they wanted to. If they did, it would kill the consolidation market.
You think so?
Well, actually, no. I know.
It will certainly slow it down.
It's interesting because, so the private equity funded piece of consolidation, you're right, it would arguably level the playing field. So, you have established UK businesses that are bolting acquisitions into their existing UK businesses, as you know, and they're not in a position where they can hide lots of leverage offshore generally. So they're arguably at a disadvantage when it comes to bidding against some of these private equity funded vehicles. So you wouldn't kill consolidation altogether, but it would make it a lot harder for some of these PE funded vehicles to progress. But as I say, if you asked me this 2-3 years ago, it'd have been very easy to paint the direction of travel. Whereas I think they're a little bit reticent to push hard on that because it would drive investment out of the UK advice sector. If you want to close the advice gap, don't you want external investors putting lots of money into the UK advice industry? So you kind of. But we'll see. Anyway, we have the consolidator thematic review feedback will land at some point, and we'll see where that goes. So maybe some baby steps towards addressing some of those offshore debt stacks. The concern is legitimate, which is if you've got a UK regulated entity, which might have, on the face of it, have plenty of reg cap, meet its reg cap requirements on a solo basis, but it's also having to continuously fund through distributions, dividends, etc., to basically pay the interest on. That the question is, well, are you really focused on delivering good customer outcomes, or are you really just focused on covering the interest payments? So it's a legitimate question to ask.
So putting your lens, your of course, you got your regulatory and risk hat on, right? But also, you're also married to a financial planner.
I am. Yes.
I can cut that off if you don't want me.
No, that's fine. No.
I'm not going to say who. Would you say this trend towards consolidation, this large private equity backed debt fold, in many cases, conflict reading, would you say this is good for consumer outcome, financial advice generally? Would you be neutral? You can't be neutral. Would you say it's good or bad?
I'm married to a financial planner. She's runs her own business. It's a power planner and a small number of clients. So she's at the micro end of the spectrum.
A fantastic one.
Well, no, she's
really good.
Yeah. Well, I'm glad you didn't ask me about whether I was getting ongoing servicing, getting my needs met. So she's an example of someone who she's never going to sell that business. She's and I guess my view of there is consolidation happening. Obviously, there will continue to be consolidation happening, and also there will be a continuous spin-off from individuals saying, "I don't fancy being part of this vehicle." And so the industry, I think, as a whole, it does a great job. I mean, we can talk about the demographics and all the good stuff, but at one level, it's continually creating new businesses at the bottom end. So it's never going to turn into a monolith where there's just a small number of giant, one size fits all type advisors. Generally, I think consolidation is a good thing to the extent that it does raise standards. The regulator thinks that generally it's a good thing because organisations that haven't got the money to invest in their systems or their compliance arrangements suddenly will tend to have that, or part of a bigger platform type arrangement. So done right, it is generally a good thing. I think I think one thing that ongoing advice and our targeted support, the ongoing advice issues and our targeted support is illustrating and supporting is this idea that advice firms are going to become even more disparate in terms of the types of service offerings. I think there are clearly those that won't get out of bed unless you've got like 5 million in the bank or something like that, very top end. And then there are others that are investing and developing systems, etc., and advisor models that hopefully will allow them to provide decent quality ongoing advice to people with like 150,000 or something like that. So consolidation and money coming in is allowing that kind of differentiation, I think, which is a good thing.
I can't believe I'm going to say this. Having a conversation about risk and regulation has been quite insightful, David. And that's credit to you. Not usually, a topic that gets me going, but you've done it justice.
Well, I'd say it's kind of fascinating time because I think the regulator is feeling their way through this new environment and trying to balance growth and I'll maybe you can bring me back in a year's time and we can all laugh about how catastrophically wrong I was on almost everything.
I will certainly take you up on that offer. So you're running the FCA for a day, just a day. What do you do? What do you change? What do you bring in or get rid of? What do you do?
Goodness me, a day. A day's bit
You're
tricky.
A king for a day. You can do whatever you like.
Well, I think that move out of Stratford, I think, would probably be maybe most popular with the staff. It's a really tough. I mean, I feel for the senior staff at the FCA every time they have to go and sit in front of the Treasury Select Committee, for instance, and get strips torn off because that growth versus consumer protection piece is incredibly hard to balance. So I think if I was in charge of the FCA for a day, I would probably spend that writing my resignation letter.
David Morrey, thank you for your
Hey, Graham, thank you.
Thank you for your time. Thank you for your wisdom. Thanks for coming on this show. I've really, truly enjoyed our conversation.
Thank you. It's been fantastic for me too.
That's a wrap on today's show. Massive thanks to my production crew, especially Jake Osha, Melissa Canham, and the entire team. And of course, to our sponsor, Timeline, the market-leading provider of integrated planning technology and model portfolio service to advisors. I do hope you've enjoyed today's show. Head over to Apple Podcast and give us your review there. Until next time, goodbye.